Hello, welcome to the topic of preparing journal entries. And actually, the type of journal entries that we're going to prepare in this problem are adjusting journal entries. So the thing we have to remember when we're thinking about adjusting journal entries is that sometimes things change. So assets like supplies, rent, and equipment can be used up. Additionally, we could have accrued revenues and accrued expenses, which are accrued because we've not paid out cash yet or received cash yet, and yet once the cash is received, those accrued revenues and expenses change. So let's consider a case where we bought supplies, our business bought supplies on June 1st, 2015, and as a result, we recorded a $1,000 debit. So remember how that works. It would be a debit to supplies for $1,000, a credit to cash, and supplies are an asset. Well, on June 30th, it could well work out that they're no longer $1,000 worth of supplies. For example, we might do a count, and the count could reveal that there's only $250 worth of the supplies left. And that would seem to mean that 750 were used. This would cause the need for an adjusting journal entry at the end of the month. And here in the middle of the page, actually a little towards the bottom, I've provided that entry. We would debit supplies expense for $750 and credit supplies for $750. Now at the very bottom, I show you what we've done. By doing this entry, we've increased supplies expense, or debited it, $750, and we've decreased assets, supplies, and now the balance is only $250. Well, there are other types of transactions besides supplies. For example, imagine that on January 1st, 2015, we paid $12,000 for annual rent. Well, we haven't incurred the rent yet, but we had to pay it in advance. So, we would have debited prepaid rent, $12,000, credited cash $12,000, but then monthly adjustments would be necessary. So the monthly portion is $12,000 divided by 12 if it's annual rent, and this turns out to be $1,000 per month. The original entry I've shown you is a debit to prepaid rent $12,000, credit to cash $12,000. However, the June necessary entry is a debit to rent expense and a credit to prepaid rent. Now that meandering red line that I show you with the debit and then offsetting credit to prepaid rent shows you that if those two transactions were the only ones, prepaid rent would now be $11,000. In the first transaction, we've debited it. In the second transaction, we've credited it. Since it's an asset, we're making it go down. Let's consider what we've done then. At the end of the day, what did we do here? Well, with regard to account 609, prepaid rent, and I just made up the numbers 609, it's actually also wrong. I just looked at it again, and that should be 109, prepaid rent. It's an asset. It should have a 100 number. So with 109 prepaid rent, The original balance is $12,000. The adjustments which should have already been done in January through May would have been $5,000. This adjustment I've just shown you would be another $1,000, and the June 30th asset balance and prepaid rent would be $6,000. Notice then that credits of $6,000 were applied against the original prepaid rent. Meanwhile, rent expense would have gone up $5,000 for the previous months and then $1,000 more for this month. And so rent expense over the course of the year so far has gone up $6,000. Well, let's consider then a case where we buy equipment and that equipment's going to last longer than a year. We've seen several examples of this already in the first few chapters. So imagine we buy a computer and the computer is going to last for 5 years. We paid $2,000 on January 1st, 2015. If we do proper accounting at June 30th, we're going to have to show some expense for the month of June. Now, there's some things here, and in this case, it's really not the month I'm showing you, but it's rather the whole year, to date. Let me explain a little further what I mean. So, we bought this equipment on January 1st for $2,000. If we had used the equipment for a whole year, it would have depreciated $400. And I show you that calculation at the bottom. However, we've only used it half the year, only January 1st through June 30th. So we're going to take half that amount, or 6 months out of 12 months, and our depreciation entry is $200. So to do proper accounting at June 30th, we debit depreciation expense, $200, and we credit accumulated depreciation, $200. Now watch, accumulated depreciation, as you'll see in the next slide, is a contra asset. So it's not exactly equipment, but it's related to equipment. It has an asset number, it's related to equipment, and it brings the equipment balance down. Now the last thing I want to mention on this slide before we go on is that this has no direct relationship to the value of the equipment. So I don't know if you've ever experienced a computer a month after you buy it, but I doubt you would be able to sell it for $1,800, $2,000 minus $200. Instead, people would just go get a new computer. If, $1,800 and $2,000 would seem about the same to them, and they wouldn't know what kind of problems this computer might have had. So you should look at depreciation as taking that cost that we originally paid for the asset and expensing it over the period that the asset will be used up. In other words, this is an allocation. This is where we're allocating expense rather than showing it all as a debit to equipment expense right away. We're showing it go to expense only over the period that we're using the equipment. But it has no direct relationship to the change in the value of the equipment. What did we do here then? Well, what we did is we've taken account 110, the equipment. It has a balance of $2,000. We've left that balance intact. But then we've shown a contra asset, account 111, accumulated depreciation, with a $200 credit. Now when we net those, the $2,000 debit against the $200 credit, we have the net book value of equipment showing as $1,800. Accountants don't want to change the value of the equipment in the equipment account. If this item is the only item we have, this computer, you'll be able to find an invoice for the computer for $2,000 and match it to the equipment account for $2,000. If we had 3 more computers in here, you could match invoices to $8,000 for the computers. And if you started netting depreciation against the equipment, you could no longer trace the invoice to the account. And we like doing that. So rather, we set up a separate contra account. Notice that at the same time assets went down $200, depreciation expense went up $200. Let's spend just another minute or two thinking about how we might use journal entries, in this case adjusting entries, to handle accrued revenue and accrued expense. So the accrual method means we don't care when cash is received or paid. We care when revenue is earned or expenses incurred. So in this first revenue slide, it may have worked out that we completed work for a client in, let's say, a legal business. And we did the work, may not have even billed them, or we might have billed them. But we did the work, it's done, maybe represented them in court. So the debit to accounts receivable is $5,000, showing an asset going up $5,000. And we've credited fees revenue, the income, $5,000. This is the adjusting entry. If we did this by January 31st, we're going to show it at January 31st. Now, the second entry I'm showing is not an adjusting entry, but do notice that on June 10th, if in fact the customer pays us the bill, at this point we'll show cash coming in with a debit to cash and a credit to accounts receivable. Notice that we would not want to show fees revenue anywhere in this transaction because fees revenue went up as it should when we did the work, and fees revenue does not go down or net to zero when we get paid for it. And then let's look at an expense. Common expenses, we have people work for us, and as you know, if you've ever worked, the minute you do the work, you're owed the money. But may come to the end of May, and we've had people working the last week of the month, and we didn't pay them yet. Maybe payday is on June 8th. In my case, I'm showing it June 10th. So when we finally pay them for the work they did last month, we will show a credit to cash, but on May 31st, it's very important that we show that we owe money for these salaries, and also that there was expense related to this month. So we debit salary expense $10,000, credit salary payable $10,000. Debit an expense, credit a liability. Then on June 10th, when we actually pay the bill, we debit salary payable and credit cash. Well, this is an overview of some of the more common adjusting entries. Adjusting is a very important part of accounting and a part that sometimes I find students feel is a bit complicated. Let me know if you have questions. Take care.